In the ever-volatile digital assets, even single-digit percentage moves in Bitcoin can signify profound shifts in market structure and sentiment. This analysis delves into the anatomy of the significant downturn experienced in the last 24 hours, where Bitcoin's price fell by nearly 6%. This event, occurring on October 17, 2025, was not a random fluctuation but the culmination of a potent combination of deteriorating macroeconomic sentiment and a surge of concentrated selling pressure across both spot and derivatives markets. We will dissect the primary catalysts, beginning with the external shocks from hawkish central bank commentary and disappointing economic data, which soured investor risk appetite globally. Subsequently, we will explore the internal market mechanics that amplified this initial shock, examining the on-chain data, technical breakdowns, and the role of derivatives in accelerating the price decline. This paper argues that the 6% drop serves as a critical case study in Bitcoin's evolving identity, an asset increasingly sensitive to traditional financial signals, yet still governed by its unique, crypto-native market dynamics. The event underscores a market at a crossroads, testing its maturity and forcing participants to re-evaluate risk in a complex and uncertain global environment. The preceding weeks in the cryptocurrency market had been characterized by a fragile, yet optimistic, calm, following a period of consolidation in the third quarter of 2025. Bitcoin had successfully reclaimed and held the psychologically significant $120 level. Market sentiment, as measured by various indices, had crept from neutral back into greed, with open interest in derivatives markets steadily rising. The dominant narrative was one of resilience, suggesting that the market had absorbed the inflationary pressures of the past few years and was positioning itself for a new leg up, driven by continued institutional adoption and progress in Layer 2 scaling solutions. This fragile equilibrium was shattered in the last 24 hours. In a swift and decisive move, Bitcoin's price broke down, cascading from a stable perch around $124.500 to find a local bottom near $117.200, a drop of nearly 6%. This downturn was not isolated, it sent shockwaves across the entire digital asset ecosystem, with major altcoins experiencing even more severe declines. Billions of dollars were wiped from the total cryptocurrency market capitalization in a matter of hours. This analysis seeks to answer the crucial question: why did this happen now? The answer is not singular but multifaceted. The 6% drop was the result of a powerful 1-2 punch. The first blow came from the outside, a string of negative macroeconomic signals that forced a global, risk-off, pivot. The second blow came from within, the translation of that fear into tangible, overwhelming selling pressure that the market's existing liquidity could not absorb. To fully understand this event, we will structure our investigation as follows. We will first examine the external catalysts, focusing on hawkish rhetoric from central banks and concerning new economic data that created a hostile environment for risk assets like Bitcoin. We will then turn inward, dissecting how this negative sentiment manifested as concrete sell orders. This includes analyzing spot market behavior, the influence of derivatives, and the psychology of market participants. This section will explore the technical and on-chain data that both precipitated and confirmed the downturn, looking at key support levels, exchange flows, and the behavior of different investor cohorts. Finally, we will assess what this downturn means for the market's health, its prevailing narratives, and what key indicators to watch in the days and weeks ahead. This event, while painful for market participants, offers a valuable, real-time look into the complex forces that govern the world's premier digital asset in an increasingly interconnected financial world. Bitcoin's correlation with traditional risk assets, particularly high-growth technology stocks like those in the Nasdaq 100, has been a defining feature of the post-2020 market. Its price is no longer determined in a vacuum but is deeply sensitive to the cost of capital, inflation expectations, and global growth forecasts. The downturn of the past 24 hours was seeded in this macroeconomic soil, which had turned decidedly bearish. The primary catalyst that soured global market sentiment was a speech delivered yesterday by a prominent traditionally dovish member of the Federal Reserve's Board of Governors, whom we will call Governor Amelia Thornton, speaking at an economic forum. Governor Thornton struck an unexpectedly hawkish tone, sending a clear signal that the central bank's fight against inflation was far from over. Her key remarks, which were quickly disseminated across financial news terminals, included: she noted that while headline inflation had cooled from its peaks, the core services component, particularly wages, remained unacceptably high. This pointed to a more entrenched inflation problem that would require a more resolute policy response. She explicitly pushed back against market expectations for potential rate cuts in the first half of 2026, stating that the current policy rate would likely need to be maintained, or even raised further, well into the coming year, to ensure inflation returns decisively to the 2% target. Thornton also quashed rumors that the Fed might consider slowing the pace of its balance sheet reduction, QT, confirming that the program would continue at its current pace, systematically withdrawing liquidity from the financial system. The market's reaction was immediate and negative. Governor Thornton's comments were interpreted as a clear signal that the era of easy money was definitively over and that restrictive monetary conditions would persist. For an asset like Bitcoin, which is a non-yielding asset at the far end of the risk spectrum, this is a direct headwind. Higher interest rates increase the opportunity cost of holding Bitcoin versus a risk-free asset like a U.S. Treasury bond, which now offers a competitive yield. The prospect of sustained high rates and reduced liquidity caused institutional investors and asset allocators to immediately begin de-risking their portfolios. Compounding the monetary pressure was a duo of economic data releases from the United States that painted a concerning picture of the economy, one that hinted at stagflation, stagnant growth combined with high inflation. The latest monthly retail sales report came in significantly below expectations, showing a contraction of 0.8% against a forecasted flat reading. This was a clear sign that consumer spending, the main engine of the U.S. economy, was beginning to falter under the weight of high interest rates and persistent inflation. On the same day, the Producer Price Index, PPI, a measure of inflation at the wholesale level, came in hotter than expected. The report showed a month-over-month increase of 0.6%, doubling the consensus forecast of 0.3%. Since PPI is often a leading indicator for the Consumer Price Index, CPI, this suggested that inflationary pressures were not abating as quickly as hoped and could re-accelerate. This combination is toxic for markets. Weak growth data suggests corporate earnings will suffer, while strong inflation data suggests the Federal Reserve has no room to pivot to a more accommodative stance. This stagflationary fearbox investors in, leaving few attractive places to allocate capital and triggering a flight to safety, primarily to the US dollar and short-term government bonds. Risk assets across the board, from equities to crypto, were sold off in response. While not a direct trigger, simmering geopolitical tensions between the US and China over technology supply chains provided a negative background hum. Renewed rhetoric from both sides regarding export controls on semiconductors and critical minerals added a layer of uncertainty to the global growth outlook. This combination of hawkish Fed policy, stagflationary fears, and geopolitical risk led to a significant rally in the US dollar index, DXY. A strengthening dollar is typically bearish for Bitcoin, since Bitcoin is priced globally in USD. A stronger dollar makes it more expensive for buyers using other currencies. Furthermore, a rising DXY often signals a global flight to safety and a tightening of financial conditions, both of which are negative for risk assets. The negative macroeconomic sentiment provided the why for the downturn. The market's internal mechanics provided the how. The fear and uncertainty were translated into intense, concentrated selling pressure that overwhelmed the buy-side liquidity. The first wave of selling originated in the spot markets, where Bitcoin is bought and sold for immediate delivery. This was a multifaceted phenomenon. The most immediate reaction to the macro news came from institutional funds and large traders. These sophisticated players, who are highly sensitive to changes in monetary policy and the cost of capital, began to reduce their exposure to Bitcoin as part of a broader portfolio reallocation away from risk. On-chain data tracking services began to flag significant movements of Bitcoin from large, older wallets, often associated with whales, to addresses associated with major exchanges. This is a classic leading indicator of an intention to sell. For traders who had bought Bitcoin during its recent consolidation in the $115–120 range, the move above $124 represented a healthy profit. The negative macro news provided the perfect catalyst for them to take profits off the table before the trend reversed. As the price began to fall, it quickly dipped below the cost basis of investors who had bought in during the optimistic surge of the past week, seeing their new positions turn negative in a rapidly deteriorating environment. Many of these weak hands panic sold to avoid further losses, adding to the downward momentum. This convergence of selling pressure was visible in the exchange order books. Large sell walls began to appear at key resistance levels, while the buy walls providing support were progressively thinner and were quickly consumed by the wave of sell orders. While the 6% drop was not as severe as the flash crashes that can see 20% plus declines, the highly leveraged derivatives market still played a crucial role as an amplifier. The initial price drop of 2 to 3% was sufficient to trigger the liquidation points for the most aggressive traders, those using 50x to 100x leverage. While a smaller cohort, the forced market selling of their long positions added immediate and intense pressure, pushing the price down faster than spot selling alone would have. This initial wave of liquidations pushed the price down further, in turn triggering the liquidation levels of traders using more moderate leverage, 20x 30x. This created a mini cascade, a smaller scale version of the full-blown liquidation events seen in major crashes. Billions in open interest were wiped out, with data showing over $700 million in long position liquidations across the market in the 24-hour period. This forced selling is indiscriminate. It is an automated process that relentlessly pushes the price down until the leverage is flushed out. The sentiment shift was also clearly visible in the funding rates for Bitcoin perpetual swaps. In the days leading up to the drop, the funding rate was consistently positive, meaning that traders holding long positions were paying a premium to those holding short positions, indicating bullish sentiment. As the macro news hit and the price began to fall, the funding rate rapidly declined, briefly turning negative on some exchanges. A negative funding rate signifies that shorts are now paying longs, indicating that bearish sentiment has become dominant and traders are aggressively opening positions to bet on further price declines. This flip provided real-time confirmation of the bearish pivot and encouraged more traders to join the short side. Beyond the macro narrative and market mechanics, the digital footprint left on the blockchain and the patterns on the price charts provide a more granular view of the downturn. The 6% drop was technically significant. Prior to the event, Bitcoin had been trading in a well-defined range. The price decisively broke below the crucial support level at approximately $120. This level had been tested and held multiple times, making it a key psychological and technical floor. The violation of this support triggered a wave of automated sell orders from algorithmic trading systems. The downward move also pushed the price below its 50-day simple moving average, SMA, a widely watched indicator of the medium-term trend. For many trend-following traders, a break below the 50-day SMA is a clear signal to exit long positions or initiate short positions. This technical failure added significant momentum to the sell-off. On-chain analysis, which examines data directly from the Bitcoin blockchain, painted a clear picture of distribution, selling, rather than accumulation, buying. As mentioned, a key metric is the net flow of Bitcoin to and from exchanges. In the hours leading up to and during the price drop, there was a significant spike in the exchange net inflow. This showed that a large amount of Bitcoin was being moved from private wallets onto exchanges, signaling an increased intent to sell. This was not a supply shock of coins being taken off the market, but the opposite. The spent output profit ratio, SOPR, is a metric that shows whether coins being moved on a given day are being sold at a profit or a loss. The SOPR for short-term holders, coins younger than 155 days, dipped decisively below 1 during the crash. This is a crucial signal. It means that recent buyers, who are typically more speculative, were now selling their coins at a loss. This is the definition of panic and capitulation within this cohort, and it confirms that the uptrend's momentum was broken. While not the primary driver, there was also a slight uptick in the flow of Bitcoin from miner wallets to exchanges. Facing rising energy costs and a lower BTC price, some miners may have been forced to sell a portion of their holdings to cover operational expenses, adding a small but steady stream of supply to the market. A 6% downturn in a single day is more than just a fluctuation. It's a significant market event that reshapes narratives, tests investor resolve, and sets the stage for the next major market move. This event serves as a stark reminder that the crypto market remains a two-sided risk environment. The optimism of the preceding weeks had led to a degree of complacency, with leverage building up and participants focusing solely on the upside potential. This drop forcefully reintroduced the reality of downside risk. However, the fact that the decline was halted at 6% without devolving into a full-blown 20% plus flash crash can be viewed as a sign of increased market maturity. The presence of more institutional players, deeper liquidity pools compared to previous cycles, and more sophisticated market makers may have helped to absorb the selling pressure and prevent a total meltdown. It demonstrates that while highly volatile, the market structure is more resilient than it was in its earlier days. This downturn powerfully reinforces the narrative that, in the current macroeconomic regime, Bitcoin functions less like a non-correlated, digital gold, or an inflation hedge, and more like a high-beta, long-duration technology asset. Its price reaction was almost perfectly in sync with the sell-off in the Nasdaq futures market following the Fed commentary and economic data. This understanding is crucial for risk management. Investors must acknowledge that as long as monetary policy remains the dominant driver of global markets, Bitcoin's fate will be closely tied to the outlook for interest rates and economic growth. The market is now at a critical juncture. The path forward will likely be determined by the battle between bears, emboldened by the macro environment, and bulls, looking for discounted accumulation opportunities. The immediate focus is on whether the local bottom around $117.200 will hold. A failure to do so would open the door to a test of the next major support zone, which lies near the 200-day moving average, currently around $112. On the upside, the former support level of $120 has now become the primary resistance. A decisive reclaim of this level would be necessary to signal that the downturn was merely a shakeout and that the bullish trend remains intact. The market will be hypersensitive to any further speeches from Fed officials and, most importantly, the minutes from the next FOMC meeting. The next CPI and jobs reports will be critical. A cooler than expected inflation print or signs of a weakening labor market could revive hopes for a less hawkish Fed and spark a recovery. Watch for signs of large-scale accumulation on-chain, such as a sustained increase in exchange net outflows and whale wallets returning to a pattern of buying, which would suggest that long-term holders see this price level as a buying opportunity. The significant downturn of the past 24 hours was not an anomaly but a logical and direct consequence of identifiable forces. A deteriorating macroeconomic picture, defined by the renewed hawkishness of the Federal Reserve and fears of stagflation, provided the powerful external shock. This shock was then transmitted and amplified through the internal mechanics of the crypto market, manifesting as intense spot selling pressure and a deleveraging event in the derivative space. The breach of key technical and psychological levels sealed the short-term bearish trend. This 6% drop serves as a necessary and sobering reality check for a market that was becoming overly optimistic. It highlights Bitcoin's ongoing struggle for identity, caught between its revolutionary long-term potential and its short-term reality as a macro-sensitive risk asset. While painful, such events are crucial for the health of a market cycle. They purge excessive leverage, shake out weak hands, and force a reassessment of risk, ultimately paving the way for a more sustainable and resilient foundation for future growth. The question now is whether this downturn is a temporary storm or the beginning of a colder season for the digital asset market. The answer will be written in the interplay between global economic policy and the unique, Evolving structure of the crypto ecosystem.